Welcome back. Joining me for a look at the market scene is Richard Court from Argon Asset Management. Richard, thanks so much for joining us today. Now, we've had a slew of economic data this week from across the globe, and I want us to start off in the US. We had retail sales and inflation numbers. Now, consumer prices have continued to ease, even though those numbers came in hotter than expected. Retail sales, in the meantime, have slowed, showing that the US consumer is somewhat under pressure. Now, Richard, surely these numbers beef up the case for rate cuts.
Well, I think a lot of people. Well, sorry, firstly, good afternoon. I think a lot of people are hoping for that. They're looking for data points that sort of justify the easing of well, not easing interest rate cuts, but actually seeing interest rate cuts. But the Fed has been quite clear that they live a two-metric sort of policy where they look at what inflation is and they look at unemployment. Now, unemployment in the US is still, appears to be under control. I think it's still below 4%. And then this last inflation print, ticked up slightly, whereas I think people were hoping that it was going to subside a bit more. So at the moment, and you saw what equity markets, how they reacted on the day, with yields rising and the equity market sort of falling off a little bit, is that it sort of speaks to maybe interest rate cuts are further down the line than what was initially expected.
Let's move over to the UK now. Things aren't looking good on that front. The economy contracted in the third and fourth quarter of 2023, slipping into a technical recession. Was this expected? I mean, the UK has been showing signs of weakness for some time, and this has been due to some internal issues, things like Brexit, the political shifts that side, and we've also seen the global issues also weigh on that economy.
Yeah, I mean, Brexit is now, I think, a bit behind us, but the UK does seem to be in a much weaker position than the US and even on the continent. I mean, the inflation is a lot higher. It's at about 5%. Having said that, retail sales numbers were released today for the month of January, and those numbers came in. Well, the increase came in at about double what the analysts were expecting. So there is still some life in the UK some way. I mean, it sort of just speaks to maybe the consumer isn't under as much pressure as initially thought. But like I said, inflation is still high. Their ability to cut rates is certainly less than what the United States, what the flexibility the United States has. And if you look at equity markets, it sort of reflects that. I mean, the UK, the broad index for the equity market is a lot lower, more lowly rated than in the US.
Listen, Richard, you're one of the few people that's not so negative on the UK. Now, Britain is not the only economy going through hardship. Europe's largest economy, Germany, is also on shaky ground. Japan just slipped into a recession. And we've seen growth in China come in slower than initially expected. Now, taking this into account and growth forecasts we've seen from the IMF, the OECD, are you by any chance concerned about the trajectory of global growth? Technically, the world isn't out of the woods just yet. That COVID recovery, we have started seeing that, but there's still those geopolitical risks still at play.
Yeah, absolutely. I mean, I must admit, just never mind my working lifetime, but in my lifetime, it's a very turbulent time at the moment with various conflicts around the world. In terms of, I mean, I agree with your statement that no, the world is not out of trouble just yet. And I think like the economic downturns in places like Germany, like in Japan, is sort of giving people the sort of ammunition to sort of call for rate cuts to try and stimulate the economy. And in China as well, especially what's happening in their property sector. So if you look at what the equity markets are saying, if you look at places like China and Hong Kong, I mean, the ratings of the broad index is incredibly low. I think for Hong Kong, the 4P multiple for the index is as low as it's been in over 20 years. So there's a lot of pessimism and worry out there, and that's starting to reflect in a lot of equity markets, not in the US, but in places like Germany and Hong Kong, and the UK. But in terms of going forward and investing and looking after people's money, it's also about the expectation and what the reality is. So you can have a situation where you can invest in equity markets in times when there's lots of pessimism, and the future just needs to turn out a little less bad as was expected, and equity markets would react positively. So it's like a second order derivative that people need to be aware of.
Before I let you go, I just want us to touch on multi-choice, right? We've seen multi-choice continuing to steal the spotlight. Shares hit a 9-month high on Wednesday, trading at around 105. Richard, this was the initial offer from Canal Plus that it put through, offering 105 Rand per share. We know that MultiChoice rejected that deal. Now, with the company trading at these levels, could we see Canal sweetening their offer?
I would expect so. I mean, I don't have any special insight into what Canal Plus or Vivendi has got planned or what they're likely to offer, but Vivendi have now gone over 35% of the economic rights of MultiChoice. They bought the vast majority of that stake at far higher prices than 105 Rand. So it's not inconceivable that they would be willing to offer more than 105. Taking that potential takeover out of it, I mean, MultiChoice still appears to be, from our side, appears to be undervalued at 105 Rand. We think there's a lot more value in MultiChoice than what has been reflected on the current share price.
Alrighty, before I let you go, what's your stock pick, Richard?
We were going for Netcare this week. It's not something that maybe many would support, but there's been lots of headlines around the NHI in South Africa the last couple of months, with the bill having passed through the National Council of Provinces and now sitting on the president's desk while he looks for a pen to sign it. So there's a lot of negativity around private healthcare. We think Netcare is in a position where their margins are not normal at the moment, even coming out of COVID. There's lots of additional costs in there, including relating to load shedding. So if load shedding dissipates or subsides, there should be some margin expansion there. We're still expecting further activity through the hospitals, through the beds that they have, which will further lead to margin improvement. And they've also been investing in some strategic projects, which are coming to an end. So those costs are no longer going to repeat. Plus, there should be benefits from those projects, all of which should lead to the margin expanding and earnings growing. And I think the market is not appreciating the potential growth in the earnings from Netcare. So we think it's cheap, and that's our stock pick for this week.
Richard, thanks for your time and those insights. That was Richard Court from Argon Asset Management.